I mean, normally when we talk about profit margins in the construction industry, we're really talking about like squeezing pennies out of a stone.
Oh, absolutely. It's just a constant grind.
Right. You're looking at field labor overruns or obsessing over material waste, trying to shave maybe a day or two off the schedule.
Yeah, fighting for every single dollar.
Exactly. But what if the most massive leak in your profitability has literally nothing to do with what happens on the job site?
That is the big question.
It really is. I mean, what if the permanent restoration of 100% bonus depreciation and, the doubling of Section 179 limits plus retroactive R&D expensing, what if all of that could fundamentally change your cash flow?
It's game-changing, truly.
Right. And what if most contractors are just casually leaving anywhere from $50,000 to over $250,000 on the table from cost segregation alone?
Yeah, it's a staggering reality when you actually look at the raw numbers. I mean, you spend all year fighting for these single-digit margins in the dirt.
Right.
And then
just hand it over.
Exactly. You just hand that hard-earned capital right back over to the government in the office.
Yeah.
Simply because you didn't know the updated playbook.
Welcome to this deep dive on scaling legends. I'm Justine, and I'm joined by our resident expert, Nicole. And today, we are talking directly to you, the construction business owners out there who are just tired of leaving hard-earned cash behind.
So tired of it.
Yeah. So our mission today is to unpack the 7 biggest tax deductions that construction owners are just completely missing right now.
Because the tax landscape has drastically shifted for 2026.
It really has. And we're going to explain the actual mechanics of, how to capitalize on these changes before the year ends.
Right. Because this isn't just dry accounting trivia.
No, definitely not. Knowing these rules is literally the difference between keeping your capital to scale your fleet and writing an agonizingly large and completely unnecessary check to the IRS.
Yeah, that distinction is critical. We're talking about utilizing the tax code as a tool for survival and growth.
Okay, let's unpack this. Starting with the most immediate cash-heavy part of that growth for any contractor, which is buying the heavy iron and the trucks.
Right, capital expenditure. Equipment is the absolute lifeblood for our listeners, so we have to start by breaking down the massive changes to bonus depreciation and Section 179.
Let's get into the mechanics of that, actually, because I know contractors who are bracing for a massive tax hit this year.
Oh, yeah. Panic across the board.
Right, because the original schedule had bonus depreciation dropping down to, 20% in 2026?
Yep, 20%. And it was slated to hit 0 by 2027.
Wow, 0.
Yeah, so they were right to be concerned. But the enormous legislative shift, the real game changer for this year, is that bonus depreciation has been permanently restored to 100%.
That is just massive.
It is. And simultaneously, the Section 179 deduction limits have doubled.
Wait, doubled?
Doubled. We're now looking at a $2.56 million limit for 179, with the phase-out threshold pushed all the way up to $5.12 million.
Okay, wait, I'm stuck on the math here. If the limit for Section 179 is $2.56 million, why do I even care about bonus depreciation at all? I mean, doesn't 179 cover me for almost everything? Why do we need both?
It's a great question, and it really comes down to scale and the phase-out rules. So, Section 179 lets you deduct the full purchase price of qualifying equipment up to that $2.56 million cap.
Okay, makes sense.
But let's say your company scales up and you buy $3.5 million worth of equipment.
Right.
Your 179 deduction taps out at that $2.56 million.
Got it.
That leaves you with $940,000 of capital expenditure just sitting there.
Right, which is a lot of money.
Exactly.
Yeah.
In the old days, you'd have to slowly deduct that remaining $940,000 over 5 or 7 years.
Painful.
Very. But with 100% bonus depreciation acting as a safety net, it swoops in to cover the rest. You get to deduct that entire remaining amount in year 1.
Okay, let's ground this in a real-world scenario. Let's say I'm a mid-sized dirt contractor, right? I make $4 million in taxable income this year. If I go out tomorrow and buy a $3.5 million fleet of excavators and heavy trucks, does that mean my tax bill just gets wiped out for that entire purchase amount right now, effectively subsidized by the government?
Assuming you meet all the criteria, yes.
Wow.
You are wiping $3.5 million off your taxable income immediately.
Mm-hmm.
But there's a massive operational hurdle here that trips people up.
There's always a catch.
Always. And in this case, it's the definition of placed into service.
Wait, placed into service? Doesn't that just mean the day I stroke the check to the equipment dealer? Like,
Yeah.
I pay for it, I own it?
Not at all. And that is exactly where the IRS gets aggressive.
Oh, really?
Yeah. You can write a check on December 31st, but if that dozer is sitting on a real car in Chicago and hasn't been delivered to your yard or job site ready and available for its assigned function, you cannot take the deduction this year.
So it actually has to be physically ready to move dirt.
Physically ready to move dirt. Furthermore, there's a specific rule regarding the types of vehicles you buy. The tax code distinguishes between, say, a luxury sports car and a piece of work equipment through the 6,000-pound vehicle rule.
Oh, I've heard of this.
Yeah, heavy vehicles over 6,000 pounds qualify for an unlimited first-year deduction under these new bonus depreciation rules.
Ah, okay. So that's why literally every contractor drives a heavy-duty truck.
Exactly.
A standard commuter sedan gets capped because the IRS doesn't want people riding off porches, right?
Right. They cut onto that real quick.
But like a Ford F-250 clears the weight limit, proving it's an actual utility vehicle for the crew.
You've got it. But here's the thing. Claiming $3.5 million in deductions requires flawless proof.
Naturally.
You need immaculate records of the purchase date, the delivery date, and the exact day it hit the dirt.
You know, there was a really interesting data point in Smart Business Automator's market intelligence report that we were reviewing for this deep dive.
Oh yeah, the audit stats.
Yeah. It turns out the number one reason contractors get killed in audits isn't fraudulent receipts. It's just sloppy dating on when equipment was actually placed into service.
It's so common.
If your records are just floating around in a shoebox or like a messy spreadsheet, taking a multi-million-dollar deduction is a massive audit risk.
A huge risk.
Which is why you need automated financial systems linking your field data to your office data just to safely take advantage of the tax code.
It's the ultimate reality of tax strategy. The code heavily favors the organized.
Always.
But, taking all these deductions on equipment implies you actually have the cash flow to buy the iron in the first place.
Right. You need the money to spend the money.
Exactly. And if all your capital is trapped in the physical real estate of your company headquarters or your warehouse, you can't fund the fleet.
That is a brilliant point. So how do we actually free up the capital that's trapped in the real estate? Because honestly, standard commercial property depreciation feels like watching paint dry.
It really is. It's brutal. Whenever you buy, build, or remodel a commercial property, standard accounting dictates that you depreciate the entire building over 39 years.
39 years. That's a lifetime.
It's a painfully slow drip of tax savings. So to free up the capital trapped in that building, you need to utilize a mechanism called cost segregation.
Okay, let's explain the underlying logic there. How do you actually segregate a building? Doesn't the IRS view the whole warehouse as just one asset living for 39 years?
Well, the IRS defaults to 39 years for the structure itself. But think about the components inside the building.
Okay.
The specialized heavy-duty electrical wiring you installed for your shop machinery, that's not going to last 39 years.
Sure.
The security systems, the paving out in the yard, the custom plumbing, even the carpeting in the office, none of that survives 4 decades.
Right, that stuff gets replaced way faster.
Exactly. So a cost segregation study brings in an engineer to literally dissect the building's blueprints and reclassify those non-structural components into 5, 7, or 15-year depreciation schedules.
Okay, so you aren't creating new deductions out of thin air, you're accelerating the timeline.
Yes, front-loading the savings.
You're separating the building from the stuff inside the building so you can write off the stuff in 5 years instead of waiting until you literally retire.
Precisely.
And the time value of money on that is just incredible. The numbers we looked at showed this generates $50,000 to $260,000 in deductions per $1 million of building basis.
The leverage is unmatched. I mean, an engineering-based cost segregation study might cost a contractor between, say, $5,000 and $15,000 to execute.
Okay.
But unlocking hundreds of thousands of dollars in front-loaded deductions translates to a 10x to 50x return on investment.
Wow.
You're bringing future tax savings into the present, which gives you the immediate liquid cash to go buy that equipment we just talked about.
Okay, so we've covered physical assets, right? The trucks and the buildings. Let's shift gears to intellectual capital.
Let's do it.
The new rules outline that research and development immediate expensing has been made retroactive to July 4th, 2026.
Yes, a huge win for the industry.
But let me play the skeptic for a moment here. When I hear R&D, I immediately picture tech bros in Silicon Valley typing code, or like scientists in white lab coats.
Right, the classic stereotype.
Yeah, I definitely do not picture a superintendent pouring concrete in the mud. How does a dirt contractor possibly qualify for an R&D credit?
What's fascinating here is that the gap between the public's perception of R&D and the IRS's actual definition of R&D costs the construction industry billions.
Billions. Really?
Billions. Construction R&D isn't about inventing a new element on the periodic table. It's about overcoming technical uncertainty.
Okay, define technical uncertainty.
If you encounter a unique site challenge, evaluate alternative solutions using engineering principles, and develop a new process or product to solve it, you are conducting R&D.
Oh, wow. Okay, so if my crew hits an unexpected underground water table while digging a foundation and our standard shoring just won't hold.
Yep. And we spend 3 weeks designing, fabricating, and testing a custom steel shoring solution we've never used before. Is that entire process considered research and development? Under the 4-part test of the IRS, absolutely.
That is wild.
You faced technical uncertainty, you experimented, you relied on hard science, and you created a specific solution.
So all that labor and material counts?
Yes. And the financial impact of the retroactive July 4th rule is massive. Previously, you had to slowly amortize those R&D expenses over 5 years.
Back to the slow drip.
Right. But now, you can immediately expense them again. That means the wages you pay the foreman to design the shoring and the steel you scrapped while testing it, those are qualified research expenses that directly lower your tax burden this year.
But the catch has to be the burden of proof, right? Like, the IRS isn't going to just take my word that the foreman was doing engineering work instead of standard labor.
You nailed it. The burden of proof is everything. You have to document the failure, the iteration, and the testing.
They want the receipts.
They want the daily logs that explicitly say, attempted standard shoring method, failed due to soil saturation, engineering new structural design.
This links perfectly back to Smart Business Automator's market intelligence report.
It really does.
Because it emphasizes that spotting these R&D opportunities requires meticulous project documentation.
Meticulous.
If you have a system that automatically tags and categorizes daily reports, site photos, and requests for information, the proof of your innovation is right at your fingertips.
Exactly.
But if it's just a vague memory in your superintendent's head, your CPA cannot legally claim a dime.
Without the data, the claim is indefensible, period. But when you do track it, securing the retroactive R&D expensing becomes a straightforward administrative task rather than a forensic nightmare at the end of the year.
Right, nobody wants a forensic nightmare. So we've systematically figured out how to optimize the business entity itself. We're wiping out liability with heavy equipment, we're accelerating depreciation on the real estate, and claiming credits for engineering solutions in the dirt.
This is a solid strategy.
But the business is just an economic vehicle, right? Yeah. Ultimately, contractors run these companies to build personal wealth.
Of course.
You've saved the corporate entity money. Now, how do we protect the owner's personal take-home pay?
This brings us to the most vital deductions for long-term wealth retirement vehicles and income structuring.
Okay.
Specifically, we need to look at the SEP IRA and the solo 401k, because business owners have tools that standard W-2 employees just do not even comprehend.
How are these fundamentally different from, like, the standard 401k I might set up for my field supervisors? My guys max out their contributions around $23,000 a year.
The difference lies entirely in the employer side of the contribution.
Okay, explain that.
With a SEP IRA or a solo 401k, the business itself can contribute massively to the owner's retirement account as a profit-sharing mechanism or an employer contribution.
So the business is paying into it, not just my paycheck.
Exactly. For 2026, the deduction limits are up to $69,000 a year.
Wow, $69,000.
And if the owner is over 50 years old, the catch-up provisions push that limit to $76,500.
That is just a phenomenal wealth transfer.
It's huge.
You're taking pre-tax money, moving it directly from your profitable business, lowering the company's taxable income, and shielding it inside your personal tax-advantaged retirement bucket.
It's the ultimate double benefit.
Yeah.
But retirement isn't the only way to protect pass-through income. The way the money flows to you today is heavily impacted by the qualified business income, or QBI deduction.
Right, the QBI deduction, which always feels a bit abstract, honestly.
It confuses a lot of people.
I like to think of it like a VIP lane at a toll booth.
Oh, I like that.
Yeah, so your pass-through entity, like your LLC or S-Corp, makes $1 million in profit. But before that money ever hits the toll booth where the IRS takes its cut, the QBI VIP lane diverts 20% of it. So $200,000 straight into your pocket, toll-free.
Yes.
The IRS only taxes the remaining $800,000.
That toll booth analogy is functionally perfect.
Wait.
But accessing that VIP lane requires navigating some incredibly dense structural rules.
Right, there's always a catch.
If your income exceeds certain thresholds, the IRS starts looking at two major factors to determine if you get to keep that full 20% deduction.
Okay, what are they?
First, the W-2 wages your company pays.
Right.
And second, the unadjusted basis immediately after acquisition of your qualified property.
Wait, slow down. Unadjusted basis. That sounds like pure CPA code.
It really does.
Translate that for someone sitting in the cab of a grader right now.
Fair enough. It actually ties everything we've talked about together. Unadjusted basis essentially means the original cost of the physical assets your business holds before factoring in all that bonus depreciation we discussed in segment 1.
Oh, okay.
Now, the IRS rewards capital-intensive businesses. If you own a massive fleet of heavy equipment and valuable real estate, that high unadjusted basis helps you maintain your 20% QBI deduction even at higher income levels.
So having the heavy iron actually protects your personal VIP lane?
Exactly. The way your assets are held and the way your payroll is structured dictates whether you get the VIP lane or get stuck paying the full toll.
Which honestly exposes the most dangerous failure point in this entire operation.
Without a doubt.
We have just outlined 7 massive, complex mechanisms. We've got bonus depreciation, Section 179 caps, cost segregation logic, R&D engineering credits, the 6,000-pound vehicle rule, high-limit retirement structures, and the QBI asset threshold.
It's a lot to manage.
It is. And none of this matters if the person filing your taxes doesn't actually understand the mechanics of the construction industry. The biggest threat to your wealth is a generalist CPA.
It is the single most common destructive force in construction finance.
Wow.
I mean it. A generalized accountant who spends their week doing taxes for, like a local bakery, a dental practice, and a graphic designer. They will completely miss construction-specific plays.
They just don't know the field.
Right. They'll see a fleet of Ford F-250s and put them on a standard commuter depreciation schedule, completely missing the 6,000-pound vehicle rule.
Yeah. Which costs you thousands.
Exactly. They won't even think to ask about the custom shoring you engineered because they assume R&D only happens in a laboratory.
It's like hiring a residential interior painter to weld structural steel on a high-rise.
Perfect analogy.
They might be great at what they do, but they completely lack the specific technical tools required for your specialized environment.
Yep.
And let's be totally honest, referring back to Smart Business Automator's Market Intelligence Report one last time, generalist CPAs struggle even more when construction financials are messy.
Oh, they panic.
They just throw their hands up, which is why integrating an AI platform that syncs directly with your project management software and ERPs keeps the data pristine.
It's mandatory at this point.
When you do bring in a specialized construction tax strategist, they can actually execute these high-level deductions instead of spending 40 hours just trying to untangle your fuel receipts.
That is the harsh reality check. A tax strategist can only build a fortress around your capital if you provide them with the right material.
Garbage in, garbage out.
Exactly. If your data is a disaster, the best CPA in the world is paralyzed.
We have covered a tremendous amount of ground today, unpacking the exact mechanisms that dictate whether a contractor scales up or bleeds out.
We really have. And it all leads to a crucial challenge for everyone listening right now.
Okay, let's hear it.
What if the biggest leak in your profit margin isn't your estimating? What if it isn't your material waste? What if the biggest leak is simply the fact that your current CPA doesn't understand the dirt-level realities of construction?
That's a heavy thought.
I challenge you to call your CPA this week. Ask them directly to explain how cost segregation and retroactive R&D credits can be applied to your recent projects.
Put them on the spot.
Put them on the spot. Because if they hesitate or if they tell you it's too complicated, you have your answer. You are outgrowing your financial team.
That is the ultimate litmus test. If they are not actively bringing these 7 strategies to you, you're just funding the government with money that literally belongs in your company.
Couldn't have said it better.
Listen, if you know a contractor who is dealing with out-of-control tax liabilities and is clearly leaving these deductions on the table, send them this leap dive. It could literally save their business hundreds of thousands of dollars this year alone, easily. Hit follow on whatever app you're listening on right now so you don't miss tomorrow's intel. Also, be sure to visit smartbusinessautomator.com to learn how to keep the documentation that makes all of these deductions possible possible, absolutely bulletproof. You cannot just expect the financial leaks to fix themselves. You have to actively hunt for the hidden value, and it starts with having the right playbook. We'll see you next time.